The secret deal that will break America. What happens when the dollar's most important secret deal starts to crack? Not tomorrow, right now. Oil that always spoke dollars is learning new languages, and the guardrails America built are starting to bend. Most people think reserve currency is a title. It's a contract. Today I'll show you how that contract was built, who's breaking it, and the three fractures you can't ignore: BRICS oil flows, sanctions blowback, and Saudi hedging. You'll see where the petrodollar came from, what signals it's unwinding, and what that means for your savings, your job, and your security. If you want to see the break, start at the foundation. The vacuum after gold, 1971's shock and the search for an anchor. Here's what actually happens when the floor drops out of the world's money. On August 15, 1971, the U.S. ended dollar convertibility into gold. Bretton Woods, the post-war system that let foreign governments swap dollars for a fixed amount of gold, collapsed in a single announcement. The dollar didn't disappear, but its promise did. Without gold, why hold dollars? That question ricocheted through every central bank. Inflation was already rising. The U.S. had Vietnam costs, great society spending, and a growing trade deficit as oil imports surged. When the gold tie snapped, confidence wobbled. Prices climbed, interest rates lurched, and the idea of the dollar as a rock-solid anchor got replaced with "trust us." Not a great sales pitch. Inside Treasury and the Fed, the dilemma was simple and brutal. If the dollar can't be swapped for gold, it needs a new reason to be held, by everyone, not just Americans. Reserve currency status isn't a slogan, it's a function. The world has to need your money to settle trade, price commodities, and store value. Gold had forced that need. Now policy had to manufacture it. At the same time, leverage in energy flipped. The U.S. moved from a dominant producer to a large importer just as OPEC's cohesion and bargaining power rose. Oil demand was inelastic. Economies ran on it. That gave oil producers something the U.S. now lacked: a lever over the global price level. If you can influence oil, you can influence everything that relies on it, which is everything. So the strategic idea emerged, quietly and urgently: replace the gold anchor with an oil anchor. If the world must buy oil and oil must be bought in dollars, then the world must hold dollars. Problem reframed. Dollar demand would come not from a promise to redeem in metal, but from a requirement to transact in energy. It's not romance, it's plumbing. Create a choke point, then route global trade through it. Most people think the phrase exorbitant privilege is just about America borrowing cheaply. The deeper privilege is this: you can export paper to pay for resources others must buy with your paper. But to keep that privilege, you need two things: unquestioned liquidity and a reason to hold your currency. Liquidity came from a deep U.S. bond market. The reason would have to come from a deal. Now inflation didn't sit still while this strategy took shape. The 1973 oil shock hit like a hammer. As prices spiked, it exposed how dangerous floating currency plus energy vulnerability could be. The U.S. needed to stabilize the dollar's role before inflation and recession, stagflation, pulled policy into a corner. That urgency sharpened the search for an anchor that wasn't gold, couldn't be mined, and didn't require a public treaty. Here's where the logic gets blunt. If you can't promise gold on demand, promise access and protection to the people who can shake the world by raising the price of energy. Oil producers didn't need ideology. They needed security, technology, and market access. Washington could offer that. In return, oil could be priced and settled in dollars, recycled back into U.S. assets, and defended by American power. That's not a conspiracy. It's incentives aligning. You might be thinking, why would the rest of the world go along? Because once the largest producers price in dollars, buyers must obtain dollars to pay them. Banks then expand dollar credit. Corporations invoice in dollars to match costs. Central banks hold treasuries to manage liquidity and FX stability. The habit reinforces itself until it looks like nature. That's how systems become invisible, through repetition. But there was a catch. Anchors don't just exist, they're enforced. If oil is the new anchor, then stability in oil regions becomes a monetary policy variable. If dollars are the language of energy, then settlement systems and correspondent banks become monetary policy instruments. And if rivals threaten that arrangement, sanctions become the penalty box. The 1970s choice to anchor on oil set up every later tool: swift pressure, treasury market depth, and a global network of banks translating foreign savings into U.S. credit. Everything changes when you grasp that the post-gold dollar relied on two feedback loops. First, trade demand. Energy invoiced in dollars pushes global actors to hold dollars. Second, savings recycling. Oil surpluses and export earnings flow back into Treasuries and Wall Street, lowering U.S. borrowing costs, which finances defense and consumption that support the system. Break either loop and the privilege weakens. Break both and you don't lose reserve status overnight. You bleed it in the margins where prices are set. There's one more piece. A floating dollar world without a commodity anchor would have forced ruthless fiscal and monetary discipline. Politically, that was unlikely. The oil anchor offered a workaround. It bought time, growth, and geopolitical leverage. It also embedded fragility, dependence on producer relationships, on financial choke points staying compliant, and on trust that reserves held in dollars were safe. That last one looked unbreakable, until recent years proved otherwise. So to see where the floor gives way, you need to see how it was built. A crisis, a vacuum, and a substitute anchor forged through energy. An anchor needs a deal and a guarantor. Now we turn to the deal that made the dollar the language of oil and the quiet clauses that are now being renegotiated in real time. The deal with the kingdom, dollars for oil and recycled surpluses. An anchor needs a deal and a guarantor. In the mid-1970s, that meant a series of quiet understandings between Washington and Riyadh. The framework was simple enough to say out loud and complex enough to live off camera. Price oil in dollars, keep surpluses in U.S. financial assets, and in return, get American security, technology, and preferential access. You don't sign this on a podium. You build it through visits, assurances, and a shared recognition that stability pays better than chaos. Once Saudi Arabia, the swing producer with unmatched spare capacity, made the dollar its pricing language, the rest of OPEC followed. Oil cargoes were quoted in dollars. Payment schedules, invoices, and hedges all shifted to dollars. Banks scaled up dollar liquidity lines for traders and national oil companies. The effect was immediate and sticky. To keep the lights on, every country needed dollars. That's not ideology, that's cash flow. Here's the important part. Those dollar rivers didn't end at the wellhead. They flowed back into the U.S. as petrodollar recycling. Think about the mechanics. Saudi Arabia runs large current account surpluses when oil prices are high. Those surpluses need a home that's liquid, deep, and politically useful. U.S. Treasuries fit perfectly. Wall Street offered custody, swaps, repo, and portfolio construction. The loop closed. Oil sold for dollars, dollars saved in treasuries, treasuries finance U.S. deficits, and U.S. deficits fund the defense and market depth that keep the system credible. Most people focus on the price of oil. The quiet magic was the plumbing. By anchoring the benchmark in dollars, you give global banks a reason to expand dollar balance sheets. That created correspondent banking relationships, clearing channels, and derivatives markets all denominated in the same unit. Price risk could be hedged on New York and London exchanges. Insurance, freight, and storage contracts sync to the dollar clock. When every part of the chain speaks the same currency, frictions drop and habits entrench. And yes, enforcement mattered. The deal had an unspoken clause. We help ensure regime stability and guard your flow. You help ensure our currency's primacy and keep your savings in our market. That's not a threat, it's a mutual dependency. If you're Riyadh, you get weapons, intelligence, and a backstop against regional shocks. If you're Washington, you get permanent external demand for your debt and a lever over the world's energy price. Both sides understood the stakes. Outcomes stacked up quickly. The U.S. Treasury market deepened into the safest, most liquid pool on Earth. American borrowing costs fell relative to peers, lubricating consumer credit, mortgages, and corporate expansion. The dollar's share of trade invoicing soared beyond America's share of trade itself. That's the privilege. Your currency does more work than your exports warrant. It also sharpened a tool that would matter later, financial sanctions. Once settlement, clearing, and correspondent banking run through your system, you can decide who's in and who's out. That wasn't the original pitch, but it became a powerful feature. There's a micro story that shows how sticky this became. An oil importer in Asia negotiates a shipment. The refinery hedges expected purchases on dollar futures. The bank arranges a dollar letter of credit. The central bank holds treasuries to backstop dollar liquidity if volatility spikes. At each step, someone needs dollars today because someone else needed dollars yesterday. That reflex turns policy into muscle memory. Breaking muscle memory requires pain. Now you might be thinking, what about alternatives back then? Realistically, none had the trifecta: large, open bond markets, global military reach, and energy region influence. The Deutschmark and yen were credible but small. The pound had history but not the scale. The Soviet bloc was closed, so the dollar-oil axis wasn't just convenient, it was practically inevitable given the constraints. But here's where it gets interesting. The very success of petrodollar recycling made the U.S. financial system the world's shock absorber. When oil prices rose, surpluses poured into treasuries and agency debt. When prices fell, some of that reversed. Wall Street intermediated the swings, offering liquidity and instruments that made the cycle tolerable. In return, sovereign wealth funds built by energy exporters, think Saudi, Kuwait, UAE, parked massive capital in U.S. equities, real estate, and private markets. The marriage deepened beyond bonds. The cost of leaving that arrangement rose with every new link. If you tried to price oil in another currency, you'd face basis risk against dollar costs, thinner hedging markets, and political friction with your security partner. If you tried to hold reserves elsewhere, you'd sacrifice yield, liquidity, or both. So inertia did the heavy lifting. For decades, it worked. Still, the structure carried embedded fragilities. It assumed American security guarantees would feel unbreakable, that U.S. fiscal discipline wouldn't drift too far, and that reserves held in dollars would be respected through any dispute short of war. It assumed producers would favor stability over leverage, and that buyers wouldn't build parallel pipes. As long as those assumptions held, the deal held. Great systems aren't just built, they're enforced, and enforcement over time creates reactions. Once sanctions, freezes, and compliance pressure started to bite, incentives shifted, quietly at first, then less quietly. The guarantor kept its promise. The counterparty started hedging. That's where the cracks begin. Enforcers and examples. The cost of leaving the dollar. Great systems aren't just built, they're enforced. And with the petrodollar, enforcement lived in the plumbing. Swift messages moving bank to bank, correspondent accounts in New York, clearing at CLS, and a web of compliance officers who could freeze you with an email. If you wanted access to dollars, you had to play by dollar rules. Step outside and the pipes turned off. Here's why that matters. Most cross-border trade isn't bags of cash, it's bank credits moving through correspondent banks. If your local bank wants to send dollars, it uses its account at a larger bank, often in New York. That larger bank faces U.S. jurisdiction. So does the messaging backbone, SWIFT, which, while based in Belgium, responds to U.S. pressure because its members do. The choke points are technical, but the power is political. Iran felt it first in full color. After the 2012 sanctions ramped up, Iranian banks were cut from SWIFT. Suddenly, invoices couldn't clear, ships were stuck, and insurers balked. Oil still had buyers, energy always does, but payment had to detour. The workaround was messy. Gold for oil via Turkey, local currency settlement with steep discounts, barter-like structures that left money trapped. Iran kept selling, but revenue shrank, costs rose, and time to cash stretched. That's the penalty box effect. Now there's a popular narrative about Iraq selling oil in euros around the early 2000s and paying the ultimate price. Let's be precise. Under the UN Oil for Food program, the UN switched the accounting currency to euros in late 2000, and related transactions followed. But the decision to invade in 2003 had broader drivers: security assessments, WMD claims, and geopolitics, not a simple currency switch. Still, the story traveled because it captured a truth people sensed. Moving off dollars can draw heat, sometimes military, often financial. Libya's rumors of a gold dinar tell a similar tale. Was there a concrete, operational plan to launch a Pan-African gold currency for oil? Evidence is thin in the public record. What's real is that Libya's attempt to carve independent financial influence met a NATO intervention justified on other grounds. People conflate cause and pretext because the pattern is rhyming. Actors that challenge the monetary order tend to face pressure from the security order. Russia is the case that changed board positions. After 2014, sanctions hit banks, energy firms, and individuals. Moscow read the message and started de-dollarizing, trimming treasuries, building reserves in gold, pushing domestic payment rails, and testing non-dollar invoicing. Then 2022 blew past the old lines. After sanctions escalated beyond the 2014 measures, a G7 and EU-led coalition immobilized a large slice of Russia's central bank reserves held in Western jurisdictions. That was the shock. Reserves, once treated as sovereign cash, turned contingent on politics. It didn't stop Russia's energy sales, but it rewrote risk models everywhere. The global message was simple. If your reserves can be frozen, they're not reserves in the old sense. Central banks don't tweet about it, but they act. Gold purchases climbed. Some shifted toward short-dated bills over longer bonds, some built swap lines with friendly partners, and more trade was invoiced in local currencies when possible. None of this dethroned the dollar, but it chipped the pedestal. Back to the mechanics. SWIFT isn't the only lever. There's OFAC, which can put you on a list and scare away every bank you need. There's secondary sanctions, which threaten third parties that help sanctioned entities. That's the chilling effect. You don't need to punish everyone, you just make the risk too high to touch the deal. Compliance desks become foreign policy outposts. Banks overcomply because the fines are brutal and the reputational hit is worse. But tools that work create incentives to root around them. That's why you saw oil for gold in Iran's case, why you see Russia take rubles or yuan from certain buyers, and why Chinese banks sometimes clear energy trades through smaller affiliates less exposed to US pressure. Each workaround is clunky at first, then it becomes a service line, then a habit. Habits become alternatives. Let me give you a micro story from a trader's perspective. You're buying sanctioned crude at a discount. You can't settle through New York. So you structure a triangular trade, settle a portion in yuan through a Chinese bank with CIPS connectivity, net out another portion via goods offset, say machinery, and park the remainder in a Dubai entity that pays vendors locally. It's ugly, it's costly, but the discount covers the friction, and the more times you do it, the smoother it gets. The lesson landed across capitals. Leaving the dollar isn't just economic, it's existential if you depend on US-controlled pipes. That's why many don't leave, they hedge. They build parallel rails, hold more gold, open Vostro accounts, sign currency swaps, and test non-dollar oil invoices in small increments. They're not lighting the bridge on fire, they're constructing another bridge next to it, quietly, so traffic can be diverted when needed. There's a final irony. The more effective the enforcement, the faster the engineering on alternatives accelerates. Everyone wants the dollar's liquidity. Nobody wants the dollar's veto over their survival. You can hold both ideas until a crisis forces a choice. Then you pick sovereignty over convenience. That's the pivot we're seeing in slow motion, not a mass exodus, but a steady migration of the riskiest flows away from the main pipe. But here's where it gets interesting. If enforcement plants fear, fear funds innovation. New rails don't start as ideology, they start as insurance. And as those rails improve, they stop being a hedge and start being competition. The sanctions backfire, weaponization, and the search for alternatives. So what happens after years of using the pipes as a club? Post-2010s, the number and scope of US sanctions exploded, and the reach went far beyond direct targets. Washington didn't just say you can't do business with X, it said, if you do business with X, you might lose access to us. That extraterritorial bite spooked allies and rivals. German CEOs, Indian refiners, Turkish traders, they all started asking their banks a new question. Not, is this profitable? But will this get us cut off? Secondary sanctions are the quiet force multiplier. You don't need to touch every transaction, you only need to make the risk calculus unbearable. Compliance departments became geopolitical command posts. A cautious email from a New York correspondent bank could kill a deal faster than any regulator's letterhead. The chills set in. Perfect for short-term leverage, terrible for long-term trust. Then 2022 crossed a line. When a G7 bloc immobilized a big chunk of Russia's central bank reserves, the message was louder than any press release. Reserves were always treated like sovereign fire extinguishers, break glass in case of emergency. Overnight, those extinguishers looked like they might be glued to the wall if you were on the wrong side of politics. That didn't collapse the dollar, but it triggered a reassessment inside every central bank risk committee. Central bankers are conservative by design. Their priority stack is safety, liquidity, return in that order. After the freeze, a fourth word muscled in, seizure. Not as a headline, but as a probability. So the portfolio math started to shift. More gold because it's nobody's liability. Shorter duration treasuries because you can roll them faster. Larger FX swap networks with friends because lines matter in a crunch. And new settlement experiments because optionality is worth real money. Trade partners reacted the same way operators always do when rules tighten. They tested the edges. Local currency settlements weren't ideological, they were practical. India opened rupee Vostro accounts for partners willing to net trade in rupees. China scaled its CIPS messaging and clearing to reduce exposure to swift pressure. Gulf sellers entertained yuan settlements in pilot volumes, not because the yuan suddenly felt safer than dollars, but because having two pipes beats one when fires start. Barter returned in sophisticated forms. Energy for goods deals packaged discounts, insurance, and shipping into one opaque bundle. Gold swaps resurfaced not as headlines, but as trade finance collateral in places where bank lines were thin. You won't see glossy brochures for this. You'll see cargoes moving, invoices netting, and lawyers rewriting clauses to give counterparties off-ramps if sanctions land mid-shipment. Here's the paradox you need to hold. Sanctions work in the short run precisely because the dollar system is dominant. But the more you rely on them, the more you fund the engineering that makes them less effective later. Every time an insurer refuses a sanctioned cargo, a new insurer in a permissive jurisdiction gains market share. Every time a bank says no, a smaller bank or non-bank lender learns the business at a fat spread. Frictions that once seemed prohibitive start looking like a price of sovereignty. Now this isn't a Hollywood reversal. The dollar isn't replaced by Tuesday. Network effects are stubborn, but edges move first. Discounts lure buyers into the parallel lane. Pilot projects become processes. And once a critical mass of traders can clear a deal outside the old rails, you've created a standing alternative, even if they only use it 5% of the time. That 5% sets marginal prices, and marginal prices move expectations. Allies noticed too. Europe bristled at secondary sanctions that treated their firms as extensions of US enforcement. Some pushed for strategic autonomy, debated an EU payments channel for humanitarian trade with Iran, and explored ways to shield companies from extraterritorial fines. The projects were clunky, but the intent mattered: reduce one-way dependence. Meanwhile, corporates updated playbooks. Treasury desks built multi-bank arrangements spanning New York, Dubai, Hong Kong, and Singapore. Legal teams negotiated sanctions snapbacks, alternative settlement currencies, and force majeure language tied to lists, not bombs. Risk managers modeled what happens if a key counterparty loses dollar access for 90 days. The conclusion wasn't to exit dollars. It was to buy insurance in the form of operational flexibility. The sanction paradox ends where trust begins. A reserve currency rests on confidence that rules are predictable and property rights are durable. If key actors start thinking that reserves and transactions are contingent on alignment, they won't quit the system, they'll dilute it. And dilution, not destruction, is how dominance fades. More pipes, more currencies, more gold in vaults, fewer assumptions that tomorrow looks like yesterday. Once trust wobbles, engineers get busy rebuilding the pipes. That's the pivot, from enforcement as leverage to innovation as defense. And those new pipes aren't theoretical anymore. They're moving real value in real time around the toll booths we used to call unavoidable. New pipes, payment rails that bypass the dollar. Once trust wobbles, engineers rebuild the pipes. Let me show you the new plumbing, because it's not theory anymore. It's carrying real value in real time outside the US toll booths. Start with China's CIPS. People call it China's SWIFT, but that's not quite right. SWIFT is a messaging system. CIPS is both messaging and clearing for cross-border yuan. It's smaller than SWIFT, yes, but size isn't the point, function is. CIPS lets banks message and settle yuan payments with less exposure to US jurisdiction. Many participants still rely on SWIFT formats for interoperability, but the back-end clearing can stay in a yuan zone. That split message here, settle there, creates optionality. Optionality is insurance. Now this is important because a message is only freedom if you can convert and settle efficiently. Enter mBridge, the multi-CBDC corridor co-run by the BIS Innovation Hub with the PBOC, the Hong Kong Monetary Authority, the Central Bank of the UAE, and the Bank of Thailand. In pilots, banks issued wholesale CBDC claims, traded FX peer-to-peer, and settled cross-border in seconds with atomic delivery versus payment. No correspondent bank, no daylight settlement risk. FX embedded in the ledger. It's early, but the concept matters. If you can synchronize payment and FX without New York, you've reduced the choke points by design. India took a different route. Build rupee corridors with Vostro accounts. Indian banks hold rupees for foreign banks. Trade gets netted locally in rupees. It's not glamorous, and liquidity is thinner, but it works for partners willing to accept rupee balances or spend them back on Indian goods. Where did it gain traction? Places with sanctions headaches or discount incentives. Pair that with India's UPI rails going global for retail and SME flows, and you get a layered approach. Wholesale rupee trade at the top, instant pay pipes at the bottom. Russia, forced by sanctions, built SPFS, a domestic messaging alternative to SWIFT, and pushed the Mir card network for retail. Those aren't global leaders, but they knit together a sanctions-resilient zone. For energy, Russia pivoted Invoicing, rubles for pipeline gas to unfriendly buyers per 2022 decrees, and more yuan for crude headed east. Banks in China and the Gulf learned to intermediate those flows, often through smaller affiliates with less U.S. exposure. Over time, the process normalized, spreads narrowed, documentation improved, and shipping insurance ecosystems aligned. Bilateral oil deals are the headline because they hit the wellhead. China buys Russian and Iranian crude settled in yuan or in blended structures with yuan legs. India buys discounted Russian barrels settled in rupees, dirhams, or via intricate netting through Dubai desks. Gulf sellers have trialed yuan settlements for select cargoes to Chinese refiners, often hedged back or swapped through onshore-offshore yuan pools. It's not wholesale conversion, it's incremental. But increments at the margin set price references that stick. Commodity exchanges are nudging too. Shanghai's crude and metals contracts provide a yuan benchmark and onshore hedging. Liquidity still trails Brent and WTI, yet Chinese refiners don't need Wall Street to hedge local exposures. Add central bank swap lines, People's Bank of China has dozens, and the plumbing deepens. With a swap line, your central bank can get yuan on call, which makes it easier for local banks to intermediate a yuan invoice without scrambling in spot markets. Gold is the neutral bridge that makes all this workable. When counterparties hesitate to hold each other's currency, they can use gold as collateral or settlement asset. We've seen more trade finance structures where gold underpins credit, especially where banks fear secondary sanctions. Some central banks quietly run gold swaps to manage liquidity without flashing it on FX screens. Gold doesn't care about lists, and vault receipts move across borders faster than politics can. You might be thinking, if these pipes are so good, why isn't everyone switching? Because network effects are stubborn. The dollar still offers unmatched depth, derivatives, and legal certainty. But the goal of these new pipes isn't to replace that, it's to create redundancy. Redundancy lowers coercion risk. Once a buyer and seller can quote in two currencies, they negotiate terms differently. Discounts emerge, clauses change, and the old premium on dollar convenience starts to erode. There's a micro story that captures it. A Gulf exporter sells a cargo to a Chinese refiner. 10% settles in yuan via CIPS to test operational readiness. The rest settles in dollars as usual. 6 months later, after ironing out documentation and hedging, they lift the yuan share to 25%, backstopping FX with a PBOC swap line and hedging basis risk on Shanghai and offshore CNH markets. No press release. Just a footnote in a contract and a new habit on the Treasury desk. Everything changes when a critical mass can clear outside the old rails. Banks build compliance around the new flows. Insurers price the risk. Brokers quote two-way markets. Soon, you've got a parallel lane that absorbs 5, maybe 10% of traffic. That sounds small until you realize marginal trades set benchmarks, and benchmarks shape the curve everyone else uses. Pipes matter, but the wellhead is where power lives. As more oil moves on non-dollar rails, the capacity to enforce through finance shrinks at the edges. Not gone, but blunted. And at scale, edges decide who pays a premium and who earns a discount. The Saudi hedge, from exclusive partner to portfolio of powers. Pipes matter, but the wellhead is where power lives, and for 50 years the wellhead spoke with a Riyadh accent. Here's where the shift gets real. The original understanding from the 1970s tied pricing in dollars to U.S. security guarantees. It wasn't a treaty with fireworks, it was a working arrangement. Over time, it was renewed, refreshed, and quietly adjusted as leadership changed on both sides. But the link, dollars for oil, protection for the kingdom, was the core. When that link feels loose, hedging stops being optional. Saudi strategy today reads like a portfolio manager's memo. Diversify counterparties, diversify currencies, diversify capabilities. Start with the currency piece. There's been years of cautious Petro-Yuan chatter. The operational version isn't a dramatic flip. It's trial settlements with Chinese refiners, sometimes hedged back into dollars, sometimes left in yuan to fund projects or purchases from Chinese vendors. When volumes stay small, it's a test. When legal terms, credit lines, and hedges settle into routines, it's a template. The industrial link tightens that template. Saudi and Chinese firms are locked into refinery and petrochemical joint ventures, long-lived assets that naturally pull financing, feedstock contracts, and offtake agreements into tighter alignment. If you own the plant together, you're already negotiating in the same room. Currency, settlement, and pricing terms follow strategy, not press releases. Security posture is the second leg. After the 2019 Abqaiq attack briefly halved Saudi output, the shock wasn't only physical, it was political. The question inside Riyadh wasn't, is the US an ally? It was, how automatic is the backstop? That nuance matters. Since then, the kingdom has broadened its toolkit: Chinese drones and missiles, growing ties with other defense suppliers, air defense cooperation beyond one channel. Diversification here isn't a rebuke, it's risk management. If oil is your monetary anchor, you can't let one vendor define your deterrent. Now fold in clubs and corridors. Saudi invitations to join BRICS Plus and engagement with the SCO aren't about slogans, they're about options. BRICS rhetoric leans de-dollarization, but the practical play is bilateral settlement, local FX pools, and clearinghouses that reduce disruption if sanctions hit somewhere in the chain. Membership signals non-alignment in payments without abandoning dollar liquidity. That signaling alone changes counterparties' expectations. If Riyadh is open to multiple rails, traders build multiple rails. Vision 2030 is the gravitational pull. The plan needs vast capital, technology, and reliable markets for non-oil exports. The US still supplies plenty of that, but the East has scale, appetite, and often fewer political conditions. Raising funds across geographies makes sense when your domestic transformation is measured in trillions of dollars. That capital strategy bleeds into currency choices. If investors and contractors price in yuan or euros, a share of inflows and outflows will naturally avoid dollars. The quiet shift shows up in Treasury desks, not headlines. National oil company contracts include currency flexibility clauses. Settlement instructions list alternate correspondent banks in Hong Kong or the Gulf. Sovereign wealth funds rebalance toward Asian equities, private deals, and infrastructure with local currency cash flows. None of this abandons treasuries. It trims concentration. Think of it like lifting cash from 80% one asset to 60 or 65 over time. The dollar still dominates, but the marginal flows change direction. Defense guarantees and pricing power remain linked, but the link is now elastic. Washington still matters enormously. Intelligence sharing, integrated defense, and the role of US markets aren't replaceable overnight. Riyadh's move isn't exit, it's bargaining leverage. The message is subtle. We can price some barrels in other units, we can finance projects elsewhere, and we can park more reserves in gold or in Asia. Treat our security as transactional, and our pricing becomes portfolio-based. There's a micro-story traders tell. A Saudi cargo to a Chinese state refiner settles 20% in yuan through CIPS, with a PBOC swap line backstopping onshore liquidity. The remainder settles in dollars through standard channels. On the next deal, the yuan slice nudges higher, and the hedge is split between Shanghai and offshore CNH markets. Shipping, insurance, and letters of credit adapt. No drama, just operational rhythm reinforcing the hedge. Why does this matter for the petrodollar? Because the anchor's custodian is signaling optionality. When the anchor hedges, the fleet drifts. Other producers watch the kingdom's legal language, payment splits, and FX risk management. If Saudi can diversify without punishment, smaller producers accelerate. If Saudi builds deep two-way markets with Asian partners, liquidity in those channels improves for everyone else. And once liquidity exists, pricing follows. One more angle: reserves and sovereign portfolios. Public data only shows so much, but the broader pattern is clear: more gold accumulation, more Asia exposure, and continued but relatively smaller additions to US assets. The goal isn't to spark a bond tantrum, it's to smooth dependence. Even a modest decline in the share of incremental petrodollars heading to treasuries raises the marginal cost of US borrowing. Margins set yields, yields set everything. So the Saudi hedge isn't a press conference. It's a methodical repositioning. Currency pilots at the wellhead, multi-vendor defense, multi-block diplomacy, and Vision 203 capital sourcing across East and West. The petrodollar doesn't break because Riyadh slams a door. It weakens because Riyadh opens several. And once the swing producer treats currencies like a portfolio, the market treats the dollar premium like a negotiable line item. BRICS Plus, energy, and the multipolar pricing map. When the anchor hedges, the fleet drifts, and the first organized flotilla is BRICS Plus. Look at who's joined or circling: Saudi Arabia, the UAE, Iran, Egypt, Ethiopia. That's not a book club. That's energy at the source, shipping at the choke points, and demand across continents. The stated goals sound abstract: de-dollarization, local currency, trade, alternative settlement. But the practical project is simpler. Make sure oil and critical goods can move and settle even if Washington frowns. People love the idea of a single BRICS currency. That's not how operators work. Common money is politics-heavy and time-consuming. The real action is practical bilateralism. Clearinghouses, FX pools, and swap lines that let two parties settle in each other's currency and square up periodically in a neutral asset like gold or hard FX. Once the rails exist, you stitch corridors into a map. Yuan dirham, rupee dirham, ruble yuan, real yuan, and so on. No flag planting, just pipes. China sits at the center because it combines scale with plumbing. The China Gulf Energy Loop is the template. Selected cargoes priced and settled in yuan, hedged on Shanghai or offshore CNH, liquidity backstopped by PBOC swap lines, and credit supported by policy banks or joint ventures. Add the Shanghai crude benchmark for onshore hedging, and you've got a functional triangle, contract, hedge, liquidity, that doesn't need New York at every step. Not everywhere, not always, but enough to set marginal terms. India plays it differently. Pragmatism rules. New Delhi buys discounted Russian crude, pays in rupees when counterparties accept, or uses dirhams via Gulf intermediaries when that's smoother. The point isn't to fly a flag, it's to land a price. Treasury desks in Mumbai and Dubai have grown comfortable netting trade with Vostro accounts, while refiners tweak contracts to allow currency switches if sanctions shift mid-voyage. That flexibility is worth dollars, literally, in the discount it extracts. Russia's pivot is the survival case turned strategy. With Europe largely closed, trade settled and yuan surged. Russian firms issue yuan bonds, banks deepen ties with Chinese lenders, and energy invoices lean toward Asia. It's not romantic, it's routing. The more business clears in yuan, the more Russian treasuries learn to manage CNH liquidity, hedge on Chinese venues, and hold instruments outside US reach. Over time, those habits reduce the re-entry cost of staying outside the old rails. The Gulf's elevation inside BRICS Plus matters because they bring spare capacity and fiscal heft. A Saudi or Emirati willingness to settle slices of trade in non-USD turns pilots into norms. Pair that with sovereign wealth funds co-investing in Asia, sometimes with local currency returns, and the FX loop tightens. Earn yuan or rupees on exports, recycle into projects yielding in the same units, hedge locally, and only convert when you want, not when you must. Iran's inclusion adds a sanctions-hardened link. Tehran's been running off-grid arrangements for years. Goods for energy packages, gold-backed credit, and shadow fleets insured outside the usual clubs. Fold that experience into a BRICS Plus forum and you get playbooks others can adapt if pressure rises. Not elegant, but field-tested. Systems learn fastest at the edges. Africa's peace shows up through Egypt and broader outreach, ports, power, and minerals. Financing packages from China or the Gulf often include currency options and local content rules. If more commodity supply chains are funded in yuan or mixed baskets, upstream pricing adapts. You don't need to switch the world. You anchor enough nodes that dollar exclusivity fades into dollar preference, and preference is negotiable. Now, this is important because multipolar pricing isn't just about the invoice line. It's about the entire stack: benchmark references, hedge liquidity, credit terms, and last-mile settlement. BRICS Plus is building that stack in patches. Swap lines create emergency breathing room. Clearinghouses and FX pools cut spreads. Development banks offer term credit in non-USD. Commodity exchanges in Asia provide hedges that keep basis risk contained. Stitch the patches, and you've got a usable jacket. There's a micro-story from a BRICS Plus trade desk. A Brazilian soy exporter and an Indian buyer agree to settle in rupees, with an option to switch to yuan if INR liquidity thins. The hedge splits, part on India's exchanges, part on Singapore and USD for depth. A Gulf bank intermediates, using its dirham balance sheet and access to PBOC swaps to manage the yuan leg. They closed the deal at a tighter spread than last year because the corridor's thicker now. Nobody changed flags. They changed costs. Everything changes when corridors stop being exceptions. Once 5 to 10% of energy and key commodities can clear on non-USD rails with acceptable hedging and credit, pricing power flexes. Discounts for sanctioned barrels shrink. Premiums for dollar convenience narrow. And the leverage that came from our pipes or nothing turns into our pipes or these other decent pipes. In geopolitics, decent is dangerous to monopolies. So what breaks first, the dollar or the illusion of permanence? The illusion. The dollar stays dominant, but the monopoly premium erodes where the map is densest. BRICS Plus energy loops Gulf, Asia capital flows, and Russia's rerouted trade. That's enough to move the margin. And margins move the system. The three-fracture model, how the petrodollar unwinds in practice. So how does this actually break in the real world, not in headlines? Think in fractures, three distinct cracks that widen each other. Not collapse, but strain that changes prices, behavior, and power. Fracture 1 is invoicing diversification. Oil that was 90+% dollar-denominated starts shifting. First 10%, then 20, maybe 30 over time, into yuan, dirhams, rupees, or mixed-structure settlements. This isn't ideology, it's contracts that add currency options, test partial non-USD legs, and scale where operations feel smooth. Every percentage point matters. Why? Because the marginal barrel sets pricing references. If a meaningful slice of cargoes prints in non-USD, hedges, benchmarks, and basis trades adapt. That reduces the dollar's convenience premium and raises the incentive to deepen non-USD liquidity. It's a flywheel, just slower than Twitter would like. Now, this is important because invoicing is the demand side of dollar usage. If you need dollars to pay for oil, you hold them in size. If you can pay with alternatives for part of your flow, you hold fewer. Not zero, fewer. Treasury desks trim operational balances, corporates adjust cash management, banks allocate fewer lines to dollar trade finance relative to others. Small shifts multiplied globally tug on the second fracture, reserves and savings. Fracture 2 is reserve reallocation. Central banks and sovereign funds inch away from treasuries toward gold and a mix of non-dollar assets, more short-duration bills than long bonds, more gold tonnage, and a measured allocation to high-grade instruments in other currencies, particularly where trade ties are deepest. You'll see this as a trend, not a spike. The motive is safety and optionality. Less duration risk in a rising rate world, less seizure risk after the 2022 wake-up, and more alignment between what you earn and what you hold. If you invoice more in yuan or run bigger trade with Asia, holding some yuan assets reduces FX friction. Gold anchors confidence when politics is loud. Fracture 3 is the flow from energy producers, sovereign wealth funds. When oil is strong, surpluses build and need a home. For decades, the default home was U.S. assets, treasuries, agencies, equities, real estate, private funds. The shift isn't an exit, it's a rebalance. Fewer incremental dollars go to treasuries, more to global portfolios with Asian exposure, infrastructure, and deals that generate local currency cash flows. Even a modest change in the direction of new money raises the marginal cost of U.S. borrowing and thickens non-USD capital markets. Over time, that improves the capacity to price more trade off USD without painful spreads. Everything changes when you see the feedback loops tying these fractures together. As invoicing diversifies, operational dollar balances shrink at the edges. That nudges reserve managers to weight slightly less to dollars and slightly more to gold or trade-linked currencies. With fewer petrodollars recycled into treasuries at the margin, U.S. rates drift higher than they otherwise would. Higher U.S. yields raise federal interest costs, push deficits up, and increase issuance. More issuance needs more buyers. If foreign official demand is softening, domestic buyers absorb more at a price. That price is yield. Higher yields strengthen the incentive for exporters to diversify financing sources and currency mixes, which further encourages non-USD pipes. Round and round. You might be thinking, doesn't higher U.S. yield attract foreign money back? Sometimes, yes. But composition matters. Hot money chases yield. Reserve managers prioritize safety, liquidity, and political risk. If seizure risk isn't zero in their models, they won't load up the way they once did, especially at longer maturities. That's why you'll likely see more short-dated buying and fewer giant, sticky allocations at the long end. Liquidity remains, but duration appetite changes, and duration sets a lot of prices. Liquidity pockets keep the dollar on top, even as fractures spread. Euro-dollar markets, deep derivatives, and institutional muscle still make the dollar the easiest tool for big jobs. But marginal flow set marginal prices, and those move the curve. A 5 to 10% shift in where invoices clear or where savings sit can tighten spreads in non-USD venues, making them more usable for the next wave of deals. That's the S-curve of adoption at work. Slow, then faster, then plateaus. So what are the tipping points to watch? First, the share of oil priced or settled in non-USD even partially. Watch credible, sustained moves past 10%. Second, foreign official holdings of treasuries as a share of total U.S. debt. If that share keeps grinding down while issuance rises, yields will do more heavy lifting. Third, central bank gold purchases. If net buying stays elevated for years, it signals persistent distrust of paper claims relative to neutral assets. There are softer indicators too. Basis liquidity on Shanghai crude versus Brent. The depth of offshore CNH hedging. The scale of swap lines being drawn, not just announced. the frequency of currency flex clauses in producer contracts, the growth of non-US insurers and P&I clubs covering difficult cargoes. Each is a straw, together they show the wind. Here's the practical read. The dollar doesn't vanish. It loses exclusivity at the edges where leverage lived. Discounts narrow for sanctioned barrels, premiums for dollar-only convenience shrink. The US still anchors global finance but pays a higher rate to do it with less reach through the pipes. Numbers matter. Watch these dashboards and trend lines. Metrics that matter. The dashboard for a braking system. Numbers matter. So let's build the dashboard you can actually track without doom scrolling or guessing. 6 gauges. If 3 or more lean the same way for a year, the petrodollar's edge is slipping. Gauge 1, share of global trade and oil invoicing in dollars versus alternatives. Don't chase headlines, watch sustained, documented flows. What to track? The BIS and IMF data on currency use in trade finance plus credible industry reports on oil invoice splits. If non-USD oil settlement clears and holds above 10% for multiple quarters, and those invoices come with working hedges and credit lines, that's real. The signal is stickiness, not spikes. Ask, are contracts adding currency flex clauses as standard? Are refiners hedging non-USD exposure without getting crushed on basis? When yes becomes routine, the first fracture is widening. Gauge 2, foreign holdings of US Treasuries by region and by type. Start with Treasuries tick data, then drill into who's buying duration versus bills. The composition tells you the story. If official sector demand for long-dated paper trends down while bill holdings churn, that's caution, not exit. Pay attention to oil exporters, sovereign funds as well. If their incremental allocations lean more to global equities, infrastructure, or Asia credit, and fewer fresh petrodollars hit treasuries, the recycle loop is thinning. The key ratio, foreign official treasuries as a share of total marketable debt. If that ratio falls while net issuance rises, yields do more work. Gauge 3, central bank reserves, gold purchases and currency composition. Use the IMF COFER for currency shares and the World Gold Council's data for tonnage. You're looking for persistence. Elevated net gold buying over years, not months, says trust premium is moving to neutral assets. If dollar share in reported reserves grinds lower while other currencies and gold rise, that's your second fracture settling in. One more nuance. Watch undisclosed gold activity inferred from trade and balance sheet shifts in countries that don't report granular data. If buying looks larger than official prints, prudence is running ahead of transparency. Gauge 4, cross-border payment volumes on alternative rails, CIPS, mBridge pilots, SPFS linkages versus SWIFT traffic share. SWIFT's RMB tracker shows currency shares in messaging. CIPS publishes participant and value stats. The signal isn't that CIPS rivals SWIFT, it's that CIPS plus swap lines make Yuan settlement simpler. mBridge is still pilot stage, so focus on scale and frequency of tests, participants expanding, and settlement speeds with embedded FX. If banks move from sandbox to production for defined corridors, the pipe is real. Also watch offshore CNH liquidity and hedging depth. Growing two-way markets mean treasury desks can operate without emergency workarounds. Gauge 5, the US twin deficits and interest expense. The current account tells you how many dollars the world must absorb. The fiscal deficit tells you how many treasuries the world must buy. Add net interest expense as a share of GDP. If the fiscal gap stays wide while foreign official demand softens, domestic buyers and price-sensitive funds set the clearing yield. Rising interest expense crowds out options, defense, social spending, investment, which tightens the policy box just as leverage declines. Practical watch list, CBO updates, monthly deficit prints, and the Treasury's refunding schedule. Issuance up, duration extended, foreign takedown weak, yields whisper, pay me more. Gauge 6, energy market structure, OPEC plus cohesion, spare capacity, and pricing power. Monetary talk means little if the wellhead isn't aligned. If OPEC plus discipline holds and spare capacity sits mostly with producers open to multi-currency settlement, the incentive to experiment rises. Monitor announced and actual cuts, compliance, and who's adding refining and shipping capacity. Also track the spread behavior between Brent, WTI, and Shanghai crude. Narrowing, stable basis between Shanghai and Brent suggests hedgers are comfortable running non-USD risk. If insurers outside traditional clubs scale coverage for gray market cargoes at falling premiums, enforcement bite is blunting. Now knit the gauges. Suppose non-USD oil settlement sustains at 15%, foreign official long-end buying drifts down, central banks keep adding gold and Treasury issuance climbs into soft demand. That mix lifts yields. Higher yields raise the cost of being America's issuer and sweeten carry for traders, but they don't change reserve managers' seizure calculus. Result: more bills, fewer bonds, more gold. Meanwhile, alternative pipes thicken just enough that sanctioned or hedging flows avoid New York without chaos. Margins move, policy space narrows. A quick micro-story to anchor this. A Southeast Asian central bank grows trade in Yuan and adds a modest CNH bond sleeve funded by trimming some long treasuries and adding gold. At the same time, a national oil company revises master sales agreements to allow 25% settlement in buyer's currency if hedging liquidity meets preset thresholds. Their banks plug into CIPS for that slice. Individually small, together they pull two gauges. Two red herrings to ignore. One, any single-month tick print. These flows are lumpy, look at rolling averages. Two, flashy BRICS currency headlines. The practical tell is contracts and clearing, not slogans. Set your dashboard cadence. Quarterly for reserves and invoicing shares, monthly for tick and deficits, continuous for oil spreads and OPEC plus compliance. If three gauges lean away from the dollar premium for a year, treat it as structural. Okay, if this slides, what hits home first? The American spillover, what breaks on Main Street? Okay, if those gauges lean red, where does it hit you first? Start with imported inflation. A softer dollar means every imported barrel and widget costs more in dollars. Gas doesn't need a crisis to jump, it just needs a weaker currency and tighter global supply. Fuel is a tax on everything that moves: groceries, Amazon vans, flights, farm equipment. Price tags creep, then sprint. You'll hear surcharges before you see headlines. That's the first sting. Now this is important because higher imported costs bleed straight into interest rates. If foreign buyers recycle fewer petrodollars into treasuries, Washington has to offer more yield to clear the same debt. Higher treasury yields spill into everything with a rate: mortgages, auto loans, credit cards, and corporate bonds. For a family, that's a 6% mortgage becoming 7 and change. For a small business rolling a line of credit, that's a margin killer. For a big company, refinancing at higher coupons means fewer hires and slower capex. Rate gravity pulls broad. Then there's the federal interest bill. When yields rise while deficits stay wide, net interest expense climbs fast. That's not an accounting curiosity, it's a budget squeeze. Dollars that might have gone to highways, research, or schools get eaten by interest. In a pinch, governments either tax more, cut services, or borrow even more at higher rates. None of those feel great on Main Street. You don't see it on a storefront, but you feel it in slower permits, fewer teachers, or longer hospital waits. Markets will reprice. The 60-40 portfolio, a bedrock for pensions and retirees, gets stress-tested when both stocks and bonds wobble together. If the long end of the Treasury curve weakens because foreign official buyers prefer bills or gold, bond prices drop. Equities then look at higher discount rates and lower multiples. Pensions mark-to-market C-funded ratios swing, forcing contribution hikes from cities and states. That's taxes up or services down again. Employment channels are the quiet shock absorbers. Energy-intensive industries, chemicals, cement, steel, heavy manufacturing, see input costs rise and financing costs jump. Some can pass it through, many can't. Logistics firms, trucking, shipping, warehousing live on diesel and debt. Higher fuel squeezes margins, higher rates squeeze fleet financing. Retail feels it when customers trade down or skip trips because gas is pricey. Restaurants see fewer covers on weeknights. It's not dramatic, it's cumulative. Regional impacts aren't uniform. States built around long commutes, trucking corridors, and warehousing hubs will feel the pinch first. Think exurbs where every errand needs a tank, or inland manufacturing belts where freight is oxygen. Coastal metros with transit options hedge fuel better but eat higher rent costs if financing stays tight. Energy-producing states get a mixed bag, royalties and jobs up when oil is high, but borrowing costs bite when projects need capital. Boom-bust dynamics intensify. Household balance sheets get tested. Variable rate credit cards adjust quickly. HELOCs move. If wages don't keep up with headline inflation, real purchasing power slips. You see it in BNPL usage rising and in delinquency curves edging up from low baselines. The middle class tightens discretionary spend. Small luxuries go first, then durable goods. Auto sales skew to used or longer terms. The phrase payment affordability takes over sales floors. Small businesses meet the bank manager more often. Underwriting gets conservative when spreads widen and deposits get flighty. covenants tighten. That expansion you plan needs more equity or waits a quarter. Vendors ask for faster payment because their own lines are dearer. It cascades. Cash conversion cycles stretch, discounts disappear, and liquidity becomes strategy, not an afterthought. Real estate shifts from a price story to a cash flow story. In residential, inventory stays tight if owners sit on low-rate mortgages. New buyers face rate shock. Affordability indexes worsen unless prices give. In commercial, cap rates reprice to match higher risk-free rates. Offices already weak get weaker. Industrial holds if trade volumes stay strong, but financing costs still nudge valuations down. Developers who underwrote at cheap money revise or pause. Corporate America adapts, but not evenly. Firms with global, non-USD cash flows gain a natural hedge. Exporters earning euros or yuan can offset some cost pressure. Companies with pricing power, staples, pharma niches, software with must-have status, pass along costs. The weak hands are domestic, low-margin, rate-sensitive businesses with little bargaining power. They cut headcount first, freeze hiring next, and defer investment last. There's a micro-story from a suburban manufacturer. They make packaging for food brands. Resin prices rise with oil, trucking adds surcharges, their credit line resets 250 basis points higher. Their largest client demands price stability because their own margins are thin. Payroll is the lever. 2 open roles remain unfilled, overtime gets trimmed, and capital equipment purchases slide a quarter. Nobody makes the news. The town loses momentum. One more channel, state and municipal finance. Tax receipts lag the cycle. If markets reprice and real activity cools, revenues soften while debt service costs climb for new issuance or variable rate obligations. Infrastructure plans get rescoped. Public payroll growth freezes. The feedback loop deepens when pension contributions must rise to cover market dips. Local choices get harder, and they land as potholes that last longer and community programs that shrink. Energy transition costs also shift. Projects that depend on cheap financing, solar farms, grid upgrades, EV factories, feel higher discount rates acutely. Federal incentives help, but supply chains priced in non-USD bite if the dollar slips. Paradoxically, higher oil can both speed and slow transition. Speed because alternatives look appealing, slow because capital is dearer and households are stretched. So what does Main Street do? Households build bigger emergency buffers, lock fixed rates where possible, and reduce energy sensitivity. Better insulation, carpooling, route planning. Small businesses tighten working capital discipline, diversify suppliers, and negotiate indexation clauses where they can. Cities audit debt profiles, ladder maturities, and pre-fund projects before rates lurch again. None of this is glamorous. It's survivability. Here's the hard truth. The petrodollar's edge kept U.S. borrowing cheap and imports affordable. As that edge dulls, even a little, the everyday cost of being America rises, not collapse, friction. Enough friction to change hiring plans, mortgage math, road trips, and city budgets. And geopolitically, the map redraws itself while those adjustments bite at home. The geopolitical rewire, power without the dollar lever. And geopolitically, the map redraws itself when the financial lever shortens. Start with sanctions. When more trade clears off USD, the bite dulls. You can still sanction, but enforcement gets messy. Targets route through yuan corridors, rupee nets, or barter bundles. OFAC can scare big banks, but smaller lenders and state-backed outfits in permissive jurisdictions step in at a spread. The result isn't impunity, it's price. Pressure costs more, takes longer, and yields narrower outcomes. Now this is important because enforcement complexity compounds. Legal teams on every side write contingency clauses. Insurers migrate. Jurisdictions compete to be the neutral node. The U.S. can still punish, but the deterrent shifts from existential to inconvenient for mid-tier actors. Major powers calculate around it. You don't get clean choke points, you get whack-a-mole. Allies hedge. Europe talks strategic autonomy with more than rhetoric. They still rely on NATO and US tech, but they push for policy room in energy, chips, and finance. You'll see more European facilities aimed at buffering secondary sanctions, more chatter about a capital markets union that reduces dollar reflex, and a bigger role for the ECB in swap line diplomacy. It's not a break, it's a balancing act. The Middle East leans into multi-alignment. Gulf capitals manage parallel courtships, security dialogues with Washington, industrial corridors with Beijing, and financial connect with Mumbai. Their sovereign wealth funds stitch portfolios that earn and spend across currencies. As their optionality grows, U.S. requests come with a price. And that price includes recognition of currency flexibility and tech access outside U.S. export controls. ASEAN plays the long game. No one wants to choose. So they standardize local currency frameworks, expand regional payment links, and court both U.S. capital and Chinese demand. Think resilience through redundancy. 2 cloud providers, 2 rail gauges, 2 currency swaps. If pressure mounts, they pivot traffic, not principles. Defense posture gets more expensive when financing isn't cheap. Higher yields raise the carrying cost of presence. A carrier group still sails, but budget trade-offs sharpen. Sustainment versus modernization, forward deployments versus munitions stockpiles. Burden-sharing debates intensify because partners sense leverage. If America's fiscal room narrows, allies either spend more or accept less coverage. Neither path is free of friction. Great power bargaining shifts terrain. The best chips aren't only aircraft carriers, they're energy corridors, tech standards, and payment pipes. Whoever sets rules for hydrogen trade, rare earths processing, or cross-border data will extract rents and wield leverage without firing shots. Standards bodies become the new high ground. That's why you'll see intense lobbying over ISO codes for digital currencies, EV charging protocols, and carbon accounting. These decide who pays tolls on tomorrow's roads. Conflict risk creeps in the gray zone. Finance warfare goes subtler. Targeted export controls, entity list hopscotch, selective revocations of licenses, and cyber probes on settlement nodes. Miscalculation is the danger. If a pressure move backfires across a new pipe you don't fully map, you can spark a cascade, shipping delays, liquidity freezes, unexpected commodity spikes. Smaller states bear the brunt, then adjust by deepening all trails further. Feedback again. New blocks crystallize. On one side, commodity-linked networks, producers tying supply to financing packages in mixed currencies, with gold collateral and local manufacturing quotas. On the other, rules-first finance clubs insisting on transparency, ESG screens, and open capital accounts. Many countries will straddle both, picking terms deal by deal. Club competition, not Cold War binaries. There's a micro-story from an African corridor. A copper producer needs CAPEX. A Gulf Asia consortium funds it in a currency basket, repayment tied to future output, with hedges placed on Shanghai and London and a gold-backed contingency line. A Western lender offers cheaper dollars but wants governance covenants and sanctions alignment. The minister signs both in slices. That's the new normal. Layered financing, layered loyalty. U.S. soft power evolves. Universities, culture, and venture ecosystems still pull talent and ideas. But export controls, visa frictions, and outbound investment screening can dull the edge if overused. The sweet spot is selective protection plus open magnets. Keep crown jewels safe, keep the funnel wide. If policy skews too far toward walls, alternatives become sticky. Technology is the hidden lever. If U.S. firms keep leadership in AI, biomanufacturing, energy storage, and advanced tooling, that creates gravitational pull even when payment rails diversify. Partners will tolerate some policy strings to access indispensable tech. Lose that edge, and the bargaining chips shrink to defense and debt, expensive chips. Diplomacy must relearn price setting. Carrots matter, developmental finance with flexible currency terms, co-investment in critical minerals with revenue transparency, and shared infrastructure that's sovereign by design but interoperable with U.S. systems. Sticks should be precise and rare. Broad brushes fund the rival pipes you're trying to avoid. Everything changes when you accept the lever is shorter, not gone. Influence becomes a portfolio, part military, part market, part standards, part stories. The countries that thrive in this world do 3 things: build redundancy, keep trust, and move fast on tech. The U.S. can do all 3 if it treats finance dominance as a variable, not a birthright. So yes, sanctions bite less, allies hedge more, and bargaining shifts toward corridors and code. That raises the bar for strategy and lowers the return on blunt tools. The risk is drift. The opportunity is discipline. And for you, it means expect fewer clean victories and more negotiated, pricier outcomes. So how do you protect yourself while this shifts underfoot? You don't need a flag, you need a playbook. Personal Playbook, practical responses for viewers. You don't need a flag, you need a playbook. Let's get practical so you're less exposed if the dollar's premium keeps slipping at the edges. Start with currency exposure. If all your assets earn in dollars and your liabilities are in dollars, you're one shock away from imported inflation eating your cash flow. Add assets with non-USD cash streams. Simple ways. Global equity funds tilted to ex-US earnings, multinationals with large non-dollar revenue, or country ETFs aligned with your risk tolerance. If you're a business, diversify receivables, offer pricing in the buyer's currency with a hedge, or peg to a neutral benchmark plus a spread. The goal isn't to speculate on FX. It's to reduce the chance that one currency move kneecaps your plans. Hard assets are your second layer. Energy equities, broad commodity exposure, and a gold allocation hedge both inflation and seizure risk. Don't chase headlines, build policy. For many, 5 to 10% in gold across physical, vaulted, or well-structured ETFs is a durable ballast. Energy isn't just oil majors. Consider pipelines, integrated refiners, and select service firms that benefit from capex cycles. Commodities. Look for diversified baskets so you're not hostage to one supply shock. If you can't stomach volatility, scale in and rebalance on rules, not vibes. Debt strategy matters more when rates are jumpy. If you can lock a fixed mortgage at a rate you can afford, that's stability. Variable loans look cheap until they don't. Rising coupons crush flexibility. Businesses should ladder maturities, avoid giant bullets in uncertain windows, and negotiate covenants that tolerate temporary spread spikes. If you've got floating rate exposure you can't refinance, offset with interest rate hedges sized to worst-case cash flow, not best-case hopes. Duration risk is where portfolios quietly bleed. Long bonds are sensitive to rate and foreign demand shifts. If your 60-40 is heavy on long duration, model drawdowns where yields rise another 100-200 basis points and foreign buyers don't show up. You might prefer a barbell, some cash and short bills for optionality, some equities with pricing power and non-USD earnings, and leave the long end lighter unless you're paid well to wait. Income resilience beats prediction. Focus on sectors that pass costs through or benefit from volatility. Staples with strong brands, regulated utilities with rate cases, midstream energy with volume tolls, and must-have software with subscription stickiness. Cyclical luxuries and levered, low-margin businesses are late-cycle landmines. If you're an employee, sharpen skills that travel across sectors: data, maintenance, compliance, procurement. Those functions get cut last. Households build a thicker buffer. If fuel and food whipsaw, 3 months of expenses may not cover timing shocks. Push towards 6 if possible. Reduce energy sensitivity. Insulate, maintain tires and engines, batch errands, and consider carpooling or transit hybrids a couple days a week. Small moves stack. Lock essential subscriptions at annual rates if discounts beat likely inflation. Avoid teaser loans and 0% traps that reset ugly. For small businesses, cash conversion is strategy. Shorten receivables where you can, extend payables without killing supplier goodwill, and secure secondary vendors in different regions. Add indexation clauses tied to input baskets or fuel surcharges. If your bank tightens, pre-negotiate lines with a second lender. Even a smaller facility buys time. Build sanctions and FX contingencies into contracts. Alternate settlement currencies, fallback banks, and clauses that auto-switch rails if a list changes mid-deal. Real estate, underwrite cash flows, not dreams. Residential buyers should stress test affordability at rates 100 basis points above today and salary growth 100 basis points below expectations. Investors should assume higher cap rates and slower rent growth. Industrial remains resilient if you buy near multimodal nodes. Offices are a knife fight. Avoid unless you have a surgical thesis and patient capital. Don't assume refinancing terms will look like the last cycle. Taxes and benefits will shift. If state budgets strain, you may see higher levies or trimmed services. Use HSA and 401(k) shelters efficiently, harvest losses to offset gains during volatility, and plan for bracket creep if inflation reaccelerates. Retirees. Match near-term withdrawals with short-duration assets so you're not forced to sell equities or long bonds into weakness. Information is your edge, not adrenaline. Track the 6 gauges we laid out. Oil invoicing shares, foreign treasury demand, central bank gold buying, all-trail volumes, U.S. deficits and interest expense, and OPEC plus cohesion. Build a simple dashboard, quarterly check-ins, thresholds that trigger actions, not tweets that trigger trades. If non-USD oil settlement sustains above 10% and foreign long-end demand weakens while issuance rises, tilt incrementally, don't lunge. Avoid common traps. Don't all into a pet narrative like everything in gold or short the dollar forever. Systems erode stepwise, then snap in pockets. Keep liquidity. Don't ignore legal and custody risk. Understand where your assets sit, who your counterparties are, and what jurisdiction governs disputes. If you use offshore exchanges or novel platforms, cap exposure to what you can lose without a lifestyle change. Micro story to land it. A mid-sized importer hedges 30% of next year's fuel in advance, prices contracts with a fuel index pass-through, opens a small CNH account to settle a Chinese supplier 2 quarters a year and shifts excess cash into T-bills and a gold sleeve. Nothing flashy. But when fuel pops, yields grind up and the Yuan corridor hiccups, they keep shipping while a competitor scrambles. Optionality paid. One last mindset shift, probability not prophecy. You're not betting on collapse, you're pricing rising odds of friction. Build redundancy, keep trust with counterparties, and move early in small steps when the gauges lean. The origin loop closes, why the petrodollar was inevitable, and so is its unwinding. Here's the origin loop. Crisis births systems with the exact weaknesses that will later undo them. In the early 1970s, the dollar lost gold and needed a new anchor. Oil was the only commodity big enough, liquid enough, and political enough to do the job. So the US didn't pick oil because it was elegant. It picked oil because nothing else could carry the load at that speed. That choice solved one problem, global dollar demand, by creating another, tying monetary power to a volatile, strategic commodity and a single security bargain. Most people think reserve status is about flags and speeches. It's not. It's plumbing backed by trust. Gold provided automatic discipline, then oil provided enforced demand. The petrodollar worked because every factory, airline, and government needed crude, and crude spoke dollars. That created a permanent bid for treasuries, deep capital markets, and cheap financing at home. But embedded in that success was fragility. If enforcement ever pushed too hard, or if the wellhead diversified, the same network effects that built dollar dominance would start compounding against exclusivity. Now this is important because technology always squeezes monopolies. In the 1970s, cross-border settlement needed correspondent banks and human-led netting. Today, you've got synchronized ledgers, instant FX, and alternative rails that narrow spreads without asking Washington's permission. Add multipolar demand, Asia's rise, Gulf capital, Africa's resources, and the world doesn't need one master pipe to clear trade. It needs redundancy. Redundancy is the quiet killer of monopolies. Not because it's loud, but because it makes switching costs bearable. Trust turns out to be the true reserve asset. Liquidity matters, depth matters, but trust is the multiplier. When a G7 bloc froze a major power's central bank reserves, the message was the dollar died. It was property rights are conditional at the edges. Central banks heard it. Sovereign funds heard it. Corporate treasury desks heard it. The reaction wasn't panic. It was portfolio math. A little less duration in dollars, a little more gold, a little more alignment between what you earn and what you hold. That's how systems unwind, incremental moves that look boring until the compounding shows up in prices. You might be thinking, if it worked so well, why unwind it at all? Because success widens the policy toolbox, and a bigger toolbox tempts overuse. Sanctions worked, therefore they were used more, therefore alternatives got financed, therefore the deterrent eroded. At the same time, the kingdom at the center of the oil anchor learned the same lesson. Optionality is survival. If your security backstop feels less automatic, you hedge. Currency pilots, multi-vendor defense, multi-block diplomacy. Each a rational step that, in aggregate, reduces the dollar's monopoly at the wellhead. The US still has choices. Fiscal discipline would curb the issuance that forces higher yields when foreign official demand softens. Industrial policy that actually scales domestic energy, hydrocarbons and low-carbon alike, would reduce imported inflation sensitivity. A coherent sanctions doctrine, fewer, sharper, clearly conditioned, would preserve deterrence without funding rival pipes, and payment innovation led by US institutions could keep the legal certainty while modernizing rails. Those choices are hard politically, but the math is simple. Protect trust or pay more for everything. This won't be an overnight collapse. It's stepwise erosion punctuated by sudden breaks in specific places. A corridor flips from pilot to production. A benchmark gains enough liquidity that hedgers stop paying a premium in New York for every leg. A sovereign wealth fund inches allocations toward Asia for 3 years, and suddenly the marginal treasury buyer is gone at the old price. Nothing happens, then a lot happens, and afterward it looks inevitable. There's a micro story that closes the loop. In 1974, the anchor deal made sense because the world needed a new settlement truth, and the US could provide it at scale. In 2024, the Hedge deal makes sense because no single actor can guarantee universal settlement truth without asking for political alignment. Trust splits. Legal certainty here, commodity flows there, tech rails somewhere else, and gold as the peacekeeper. The end isn't a bang. It's invoices that carry option clauses, reserves that carry more metal, and bonds that carry higher coupons. So the petrodollar was inevitable then because energy was the only force big enough to replace gold. Its unwinding is inevitable now because technology and multipolar demand made exclusivity expensive, and enforcement taught everyone to pay for insurance. You don't need drama to break a monopoly. You need alternatives that feel normal. That's where we are. Less buying, fewer dollars at the margin, more options in the stack. Here's the takeaway. The dollar's not vanishing, but the comfort premium that made America's bills cheap is. If you want to track the real tipping points, subscribe and watch the next deep dive where I break down the 3 metrics that matter most. Share this with one friend who still thinks the dollar's untouchable, and queue up the follow-up on central bank gold buying Rewriting the Script.